You are listening to the Cresco Wealthcast, and I'm your host, Dimitri. I'm an advisor with Cresco Wealth Management, a division of Wellington Altus Private Wealth. The purpose of this Wealthcast is really to bring those down-to-earth conversations that we're having not only with ourselves internally, but also with clients. Just want to bring you authentic, real coffee talk convos that we can all appreciate and understand. You can follow the podcast on Podbean, www.cresco.podbean.com, as well as my Instagram page on the Instagram stories and highlights, which is at the Finance Greek. Today, I'm privileged and honored to welcome back. I can't believe a year has gone by. I mean, we've seen each other in between then, but in terms of a presentation,
It's really been a year?
It's been a year. Last one was March. I know, March 31st.
Crazy.
I know. It is crazy how time flies. But for all of those listening and watching, Dr. James Thorne, Chief Market Strategist for Wellington Altus, sits on our investment committee on the calls as well, in which we truly appreciate not just the contrarian view, just the view. And it's always good to get that voice. We've been doing a series of podcasts for Cresco. The idea was just to bring coffee talk conversations, how we're doing here, and not get completely inundated with everything that we see in the news on a daily basis. But what are we talking behind the scenes? But what I did want to highlight is you recently wrote an article for the Globe and Mail. And as per usual, very thought-provoking, opening the eyes of what people should be seeing. Maybe let's start there. Quick hit on the article. What should we be seeing right now in today's trend from that article?
So when we got together with the Globe, I said, I'm sick and tired of reading about the Fed and inflation. Let's talk about the future.
Yeah.
And really, to talk about the future, we got to go back to the past. And so if we go back to the period of time before COVID, the big problem was, how do we get out of debt, right? And how do we generate economic growth? And there was this theme called secular stagnation, and we had deflation. The last time we had secular stagnation and deflation was after 1945, right? We also talked about the fact that that was a period of time of major structural adjustments, right? The Bretton Woods Agreement was written. U.S. dollar became the medium of exchange of the economy. And at the same point in time, you had massive amounts of debt to GDP, right? So when I lived in the States, I can remember Ben Bernanke giving a presentation when I was there, and he said, no, to understand where we're going, it's not the 1970s, it's the 1940s to 1969. So I am ripping off Ben Bernanke, which is kind of, it shocks me because for whatever reason, people are anchoring off of the 1970s. So what I said to the Globe is, look, this is all wrong. Yeah. When Paul Volcker got involved and started raising rates in 1970, the debt to GDP was 35%, right? Debt to GDP is close to 140%. So they can't raise rates. We can't have interest rates higher for longer. Interest on the U.S. debt is almost approaching $1 trillion. That's more than the defense budget of $850 billion. They've got to get interest rates down, and that's one. And two, growth is going to be slow. So my objective is to sit there and to frame everybody, to sit there and go, look, where we're growing because of debt, right? And because of demographics and because of the structural changes, it looks a lot like 45 to 69. And that was the basis of the article. And the only way we can get out of this, there's two ways, right? There is we grow our way out of it. So it took 2 decades. And the U.S. went from debt to GDP of about 140 to about 35, right? Or we can go back to the Bible and we can have a debt jubilee in the Old Testament, right? These were the arguments beforehand. These were the arguments that we had coming out of the global financial crisis in 2008. Dimitri, nothing's changed. In fact, because of COVID and the amount of debt spending, these arguments are even stronger today than if you or I were sitting around in 2013, 2014, chatting about this. So that provides me, Cresco, and Wellington an opportunity to have an alternative point of view because we're willing not to just look at the short-term shiny thing that's the topical in the market or in the markets and sit back. Let's pull it back and let's calm down and let's ask the simple question: how the heck are we going to grow our way or get rid of the excessive amounts of debt in society when we also have massive amounts of unfunded liability because the baby boomers are retiring, right? This is a mathematical question. So all this other short-term stuff that people are talking about, the concern and the risk is secular stagnation. Remember coming out of 2008, when debt to GDP is over 100%, growth slows. We are going to a low growth, low inflation, low interest rate environment. Now, people listening are saying, you're crazy. I am telling you where the end point is.
That's right.
That's where it's going.
Yeah.
And if you think I'm nuts, the IMF just came out with their World Economic Outlook 3 weeks ago. And what did they say? There it is. There it is. Invest accordingly. How long does it take? I don't know.
I agree with you, because a lot of the time what we're dealing with, and you yourself, is no one can time the market. We know that. Yet we fall into the trap and we say, oh, but this time maybe we can. It's not about just timing it. It's about positioning, like you say, the end point. I find that if you clear the smoke, and this is what I love about your articles, your market insights. And by the way, you can always follow Dr. James Thorne on Twitter, on your market insights, all your channels. But what I find and what I love is how you clear the smoke and you say, look, we're looking at the same playbook. We just have a different rotation of players. I know you're a hockey fan. Look, the Maple Leafs are the Maple Leafs. It's not Matt Sundin at center this year. It's John Tavares, for example, but it's still the Maple Leafs. They still roll the same lines. Let's not get fooled here.
It's Lanny McDonald.
Okay,
for you Calgary.
I didn't want to hate you.
Folks, okay?
I didn't want to do that
Lanny
to you.
McDonald who scored in overtime in Game 7 against the Islanders, okay? That was my glory. That was the only glory
I was
I'd
giving
ever
you
had.
90s credit, Jim.
But that's it. I mean, what we are, so let's not argue about it. Let's not get upset about it. We arbitrage time. And what I want to do is to pull everybody back and just sit there and go, look, we are heading towards a low growth, low inflation, low interest rate environment. You are seeing the peaks of the rates for the cycle. Invest accordingly. That's it. Do I know how quickly the glide path is going to be? I have an idea, right? But there is no other way we're going to get out of this debt problem than to have inflation be a little bit higher than the interest rates, because if interest rates are higher than inflation, then the interest payments are growing faster than the GDP or the economy is growing, and it doesn't work. So we're going to get inflation down, and then we're going to get interest rates below that, and then we grow out of it. I think the other thing that's going to be interesting for investors is Jay Powell right now has according to Gallup, has the lowest approval rating of any Federal Reserve chairman. Okay? Any.
That's incredible.
So when we wrote the article, it was a time for the Fed to take a back seat. We think that what happens is the Fed stops trying to manage the business cycle, right? Gets out of the way, lets the market do what the market has to do, lets the economy do what it has to do. And that's exactly what happened between 1945 and 1969. So what you had is the market was up 700%, but it wasn't the great moderation that really started with Alan Greenspan in 1987. That's over. So you're gonna have like this year, you're gonna have massive rallies, and then you're gonna have a pullback, and then you're gonna have another massive rally. So it's gonna be like this. And so you need to be very proactive or come to a determination.
Okay.
Right? That the market is going to be much more volatile. Can you handle the volatility? Right? And what do we talk about, Dimitri? We sit there and go, this time next year when everybody's got the FOMO, right? Yeah. Expect a correction. Right? Yeah. And so you have to, and what's the last part of the article of the Globe? The great moderation is over. That's exactly what happened between 1945 in 1969. And as long as you can get your head around that, and realize that it's the business cycle is going to be determined by the markets and not the central bankers, that interest rates are going to be determined by the markets and not the central bankers, we're going to go back to a world that nobody has experienced. And it's going to be, for those that understand that, it's going to be wonderful. For those that think we're going to go back to the 90s or the 80s, they're going to have a tough time of it because it's going to be a completely different era.
That's incredible. And when you say 1945 to 69, or excuse me, was it?
Yeah, 69.
To 69. Someone at home wants to research, do some homework. If you could equate, are we at 45 today? Are we at 50 today? I know it's a bit of a loaded question, but where in that cycle? Are we relative in the beginning parts of that cycle, saying we're starting at 45 if you're following?
So every action has an equal and opposite reaction. So coming out of World War II, we had 3 years of 10 plus percent inflation. They contracted the balance sheet.
Okay.
All right. And we got risk of secular stagnation and deflation. We are about to see a dramatic fall in prices and deceleration of economic growth that is going to scare the living daylights out of people. This fallacy, this false premise that inflation is permanent is not supported anywhere. So we're 1950, right? Where inflation went up, they contracted the balance sheet by a third, growth went down, deflation went down, and the fears, because what did you have? Everybody thought we were going to go back to the 1930s.
Right, that's coming off the depression.
That, you know, when you look back at that time, everybody think there was fear. There was fear in China was not supposed to go fall to the communists. Then they're going to sit there and go talk about the inflation shock, right? Well, that was caused by the Korean War, right? And then you had Russia. You had a high degree of political uncertainty. And so what we would expect is an echo of the inflation spike. Mm-hmm. That's why I think people are misplaced and why we are comfortable saying we are going to see a dramatic decline in inflation just by the math, right? It's year over year price changes, right? You know, let's be clear. We're in Calgary, right? This time last year, oil was what, 120?
Yep.
Right? It's 70 now. Calculate the rate of change year over year. That is going to show up in year over year inflation. The Dallas Fed mean PCE, what our trim mean PCE. So what they do is they don't take out oil and they don't take out food. They take out the highs of the data set and they take out the lows of the data set. Since September, that data set is running at negative 2.5%.
Isn't it interesting? And then what we see day to day, what is reported on the news, completely misguided. This is what I say, this is what I love about you, Jim. Just take a look at what you should be looking at.
Well, that's why if people think they can watch TV and invest, I use a term, an old poker term, right? When you go to a poker table, if you don't know who the dumb money is at the table, then you are the dumb money. If you think that you can outperform by looking at the TV, the smart money does not go onto TV and tell you how they're positioned.
Their track record speaks for themselves.
Their track record speaks. Right. No, the people that are on. So let's go think about this, right?
Yeah.
When you turn on TV today, everybody is negative about the markets, right? The NASDAQ 100 is up 21% this year. Do you think maybe the people that are talking on TV missed the trade? Do you think? The S&P 500 is up 7%. Now, my argument is going to be this, and this is like 2003 and 2009. Wait till the end of the second quarter, right? And the NASDAQ 100 is up 25%. And let's say the S&P and the TSX is up high single digits. Everybody's going to look at the statements, and they're going to sit there and go, oh no, Fed starts cutting rates. right? Which means multiple expansion, right? What happened in '09 and what happened in '03? And to be clear, the economy, ladies and gentlemen, is not the stock market. And you're going to see FOMO, you're going to see bull market stress, and if you're positioned for it now, you're fine.
Yeah.
But what if you weren't? What are you going to do if you're an institutional portfolio manager going on CNBC all day long saying, there are strategists that have been saying all year long that we're going down to 3,000. How much longer are they going to be able to say that? Right?
They just pray and hope that they forgot what the viewer saw the day before.
Sure. Dimitri, this is
that's
not,
the game.
this is, nothing is new here.
Yeah.
Now, I would say to you, the hard part is going to be, right, when we get through this year, right, coming off of a bear market low and they're cutting rates and everybody gets their happy pill again. Mm-hmm. And then we have a slow growth environment, right? We're going to a period of time where growth is going to dramatically slow, right? It's the level of debt in society, right, is just so much that, it's a debt fueled growth. If people stop borrowing, right, growth is going to slow. Yeah. So we think that this year is going to be very constructive. We think next year is going to be a little bit more difficult. We do still think there's going to be a secular bull market, but you need to be proactive, right? So this time next year when everybody's saying happy days are here again and we do this, okay, I'll be saying raise cash, get defensive, right? Because, fundamentals are going to matter again. Growth is going to slow. And what you're going to have is you're going to have those areas of the market that are, those companies that are dependent on GDP growing for their sales. They're going to have tough time meeting their numbers.
That's incredible. And the takeaway that I'm hearing too is also maybe from the advisory side is to help set those expectations, be pre-positioned, do your due diligence and the homework.
Yes, and what did I say to you yesterday? And I'm teasing you.
I wish that yesterday we had all this. Parts of it.
But here's the thing, right? Okay, so this is not about fundamentals this year.
That's right. Yeah.
And here's what I say. Where are you from, Dimitri? What country are you from?
Greek of background.
So if you look at the Greek ETF, right now, the Greek ETF, right, 5-year high. You're telling me that's based on fundamentals? No.
My mom might be watching this. I'm gonna no.
But that's normal.
Right.
But that's normal for this year, right? So we sit there and say 4,800 on the S&P 500. Why? Because that's where the starting point was when we started all this shenanigans, right? Yes. And then once we get up there, we'll go back to like 2004. And then we got to figure out, what does growth look like? And so in 2004, it was, what it was? It's like, China's urbanizing, right? China's got a demand shock. It's commodities. I was in New York City at that time. I was working in the States. There were no analysts for oil or commodities or engineering and construction. You just went through 2.5, I'm talking into Calgary, right?
Yeah.
You went through, think about what it was like between the 80s and 2002 in terms of the oil patch, right? We had to identify that because China went into the World Trade Organization and they were urbanizing and there was this massive demand shock in energy, right? Well, guess what? It's going to be something else. I am constructive on energy because what I think, going back to your my 45 argument, to get away from going back to secular stagnation and really low economic growth, we need a Marshall Plan. And that Marshall Plan, ironically, is the drive to net zero. And what is weird and ironic about going to net zero is it's commodity intensive. Mm-hmm. There's the paradox. So what are those things? So it's oil, it's natural gas, right. It's copper, it's lithium. And so the arguments you get in Washington, D.C. and what they call the official sector is they sit there and go, no, it's not going to be as bad as you think because net zero and the move to net zero will be used as a fiscal policy for us to rebuild the economy like we rebuild and use the Marshall Plan coming out of what? World War II.
World War II. Very well said. Before I start World War III and make you late for the engagement that we're in, we're going to have to wrap it up. Listeners, thank you so much. Jim, thank you so much for joining again and for doing this podcast. We really appreciate your time and your insights. How do the listeners outside of, yes, they can come to our website, the clients that we have that get the newsletter, how do they follow you on your channels?
Just go to, I'm on Twitter. Actually, if you want to follow me on Twitter, contact Dimitri. He'll give you the handle. And then, I am continually sending emails to the team at Cresco. Talk to your Cresco representative, and if you want to call Dimitri. We'll sit down and we'll talk all day long about this. We'll talk about the fact that Lanny McDonald was a Toronto Maple Leaf before he was a Calgary Flame. Yes.
That's right. And now we can talk about all the Calgary Flames left Calgary and are finding success.
Dougie Gilmore.
Good one.
McCowan.
Now that was a team. Rob Ramage, Otto. But no, you're talking Torontoites actually at this one. That's true.
But they still haven't won a cup in my life.
Well, I'm just saying.
Anything can happen.
Anything can happen. Thank you for listening at The Finance Greek. That's my personal Instagram channel. You can get this information as well. CrescoWealthManagement.com, at Cresco Wealth Management on the socials. And of course, this podcast is on Podbean, www.cresco.podbean.com. Thank you very much, everyone. Thanks, Jim.
Thanks, Jim.